Hey guys, so welcome back to our weekly live event. This week, we're actually going to be talking about what the St. Louis Fed said. So this week we're going to go over the Fed said. All right, guys. So it's good to see everybody again. It should be a very interesting perspective this week. What's up, Ray? What's up, Spring? This week, we're going to be going over what the St. Louis Fed had to say. And we're going to be breaking down their the letter that they wrote, the article that they posted. I actually put it out for you guys to read as well. And I think it would be good just to kind of keep our perspective going. So it's good to see everybody here. It's good to see everybody again. Hope everyone had a great week. And remember, guys, on everyone on IG, on YouTube, you actually can see the board properly. On IG, it's going to be backwards. So glad to see everybody back. I'm glad to see everyone is healthy and good. So as always, we're going to go through a lesson. And at the end of the lesson, I'm going to do the Q&A and I'll answer anybody's questions, okay? So just give it a minute for everyone to log in. So how's everybody's week been? And remember, if you have any questions, you could also put them in the question section. You can ask to go to live as well. All right. So I'm going to give it another minute, and then I'm going to start with our lesson this week. How's everyone going on YouTube? All right. I'm going to give it one more minute, and then we're going to get started. A crazy hair day. What's up, guys? Hey, Sarah, what's up? All right, so I'm gonna get going. So today is today's topic is the Fed said. So the St. Louis Fed put out an article about, they said storm clouds are brewing for the real estate market. And in the beginning of the article, they were saying that initially everything looks good for the housing market. Everything is looking well. Sales are up 4.4% over last year, and that's a significant increase. It normally doesn't increase that aggressively, and that's really a great thing. Normally, the real estate market shows as a signal for a recovery. So when you see the real estate market go up, you're normally seeing that it's a sign of a recovery, or it's a sign that the economy is getting better. And if you see the real estate market going down, that's an indicator that we're going towards a recession. Now, this is a little bit different, they were saying, than normal, because we're getting mixed signals in the market. So part of it is because right now interest rates are so low that they are on record lows. And it's they believe a strong part of that housing boom is based off of how low the interest rates are. So they're saying that we have to be very cautious about thinking that because the housing market is going up, everything's getting better, because it could be artificially going up based off of interest rates. So and the other thing that they're noticing, because there's a 10-year rate and a 30-year rate on T-bills, and the 30-year rate, they would think it's going to start going up, but the 30-year rate is a forward-looking rate, and it's not going up. So based off of that, they can tell that interest rates are going to stay low for a very long time. which usually is a sign thinking that people don't think it's going to get better pretty quickly. So a lot of negative data is actually accumulating as well. The negative data that's accumulating right now which is interesting because we had 4.4% increase in home prices in the last month, but at the same time, we have about 4.4% of homeowners, mortgage holders that are 90 days behind on their mortgage. So 1 out of 20 roughly is behind on their mortgage right now, and more than 90 days behind. So, and from that data, there's other research that's showing that only half of those people are on forbearance. The other half did not elect to go into forbearance. So, which is very odd. They can elect to go into it later if they would like, but they could not, and they could just choose to give up their home. At the same time, people that are in forbearance can also choose to give up their home. Like just at the end of the 12 months, they don't have a job. That doesn't mean they can continue living in their house for free. This is the highest level of people that are behind on their mortgage since the foreclosure crisis of 08, 09. So this is another really important factor right now. So the other thing is, another big sign that they follow and they look at is banks. So a lot of what a bank does is private. They can't release to the public. But there is certain things that the bank does release to the public, and it's required to release to the auditors, which is the loan loss reserves. And basically, the bank is supposed to increase a cash reserve account where if they feel loans are going to go bad, they need cash to help cover the losses. And what we've been seeing is that the loan loss reserves have been going up. And currently, in March of 2020, it was about 1.21% was their loan loss reserves for the bank. And on average right now, September of 2020, it's about 2.9% loan loss reserves. So it's almost doubled. And the height of 2007, 2008, 2009 during the crisis, the height at that period was a little over 4%. So we're about half of where we were at the crisis, the housing crisis. So we're going to have to keep on watching this level, because if they keep on increasing the loan loss reserves, that means we have a big signal saying, hey, a lot of loans are going to go bad. So it's a kind of a future indicator as well. The next thing that actually kind of shows that things might be going bad for real estate coming soon and in the future is basically the tightening of lending requirements. So when banks tighten their lending requirements, that means less people can qualify for a loan. And if you remember a few months back, Wells Fargo, Chase, they came out with information saying, hey, they're only going to be giving purchase loans for people that have a 720 credit score and can put down 20%. Well, obviously that limits a significant amount of people, because I review a lot of tax returns. And from what I'm seeing from, not tax returns, but I review a lot of credit reports because I'm a lender. I'm seeing a lot of people under 700, a lot of people. So it's really difficult to sell properties, and it's going to become more and more difficult to sell properties if they tighten the requirements on credit score, if they tighten the requirements on down payment. So it makes it harder. Now you would say, hey, there's going to be a lender willing to give this money. And you are correct. There is going to be a lender willing to give this money. The issue with that is right now, all the lenders are super busy. So if only a few lenders are willing to take lower credit scores or lower down payment, even though there is people out there to give these loans, because they're so busy, they might not be able to actually get to everybody, which is gonna slow down the market. Give me 1 second because the battery's about to die on my camera. right now that people have actually told me, they're like, hey, I went to my local bank, I went to my credit union, and they're actually not doing cash out refis right now. So they came to me, and I'm a broker, so I have many different options, many different companies I can go to find you a loan, or find my clients a loan. And I'm able to get them a cash out refi. But the point is, it's when we're limiting the market, when we're limiting the availability of credit, of financing, that's going to have a significant impact on the real estate market. Remember, there's research that shows that of all of the money out in circulation, 97% of that money is actually debt. Only 3% is actual cash. So if we constrict the credit markets, that's going to be a significant impact on sales of consumer goods and on actual cars, homes, everything. So cash is going to become king. That's why when a lot of people are asking me, hey, I want to pay down my home, I say, well, I don't think you should pay down your home. Maybe you should keep some cash, because when a crisis happens, it's never a crisis of equity. I don't have enough equity. The crisis is I don't have enough cash. It's a liquidity issue. It is not an equity issue, right? If you have a home and you owe $200,000 on that home, and that $200,000 home loses $50,000 in value, it doesn't matter, because you're still going to live in the house. You're still going to be, paying the same mortgage payment. Same thing with your rental property. There are some people that said, well, your rental property lost value back in 2009. And I said, well, I didn't care, because the properties that I really like, I was planning on keeping, and it's still making me money. So what does it matter if it loses value? What's important is, are you collecting the money from the tenants? So we're going to have an issue, which is going to cause actual asset prices to drop, which is a great opportunity for us to come in. Think of me like a fireman. When people are running out, I'm running in and getting those fire deals. So get ready, because I feel, and what the information from the St. Louis Fed says, clouds are forming. So that just says prepare, get prepared, because when there's opportunity, those who benefit are those who are prepared for those opportunities. So now a couple other points is consumer confidence, right? Consumer confidence, in my opinion, is huge. It's very, very big, because what that means is, let's just say, even if the availability of credit went down, if people feel good, they spend money. When people feel bad, they don't spend money, they save money. I think part of the reason why that they put out all this money to help boost the stock market and to increase its liquidity is not only for people to have money to spend, but also because when the stock market prices go up, it's been shown that people feel good when they see their stocks going up, when they see the retirement account going up, they feel good, so they keep spending money. So consumer confidence currently, though, is at a 6-year low, and that's with them putting out all this money. I have a feeling that they're going to maybe put out a little bit more money, but after that, they're not going to be putting out more money. There really isn't that much money to put out. So they keep on printing it to put it out. So I feel that there's going to be more and more uncertainty. There's going to be more tightening of lending. There's going to be less cash out there, which is going to cause more of the consumer confidence to drop. More people are going to be losing their homes. So there's going to be more demand, or more supply. More supply, less demand causes prices to go down. Now, do I think they did that? Do I think real estate's a good buy? Do I think high quality stocks are a good buy? Of course, I think they're a good buy. But when the economy is bad, when people don't have money, you can buy things on sale. And that is where you make your big money. So get ready, be prepared. So guys, that was my recap of the Fed, the St. Louis Fed's article that they put out, and my little, my opinion. So do your own research. Let me know what you think. All right, guys, I'm going to open it up to a Q&A. Ask whatever questions you want to ask. I'll be happy to answer the questions and, help you with any problems you're having right now. What's up, Richard? How you doing? Good to see you too. Edward says, so does that mean foreclosure homes are the fire deals that are coming? So, Edward, I when the market tanked back in like 9, 10, 11, the market was still low. There was some foreclosed properties that were great deals. But for me, the properties that I wanted weren't foreclosures. Like, for example, I bought my 4 unit that I put out a couple of posts about. I bought that 4 unit for 180,000. It just got appraised for 550,000, which honestly I think that was a BS appraisal because a triplex down the street sold for 620,000. So how did that try to sell for 620? And you're saying my fourplex, which is in a better area, is only worth 550. It's really worth like 800. But the point is, I bought it for 180, and I think it's worth like 800 now. That was not a foreclosure. That was just a retired investor that wanted to sell. He actually was looking for someone that would do that would accept seller financing. You heard that right. Someone actually wanted to be a seller finance deal. So I put the money down, and he actually gave me the loan for his own property because he wanted to continually get the cash flow every month. Because just think about it, if you're seller finance a deal, so if I own a property and now I'm 80 years old and I actually sell it to somebody as a seller finance deal, when I sell them a property, I get a chunk of money, and then they owe me the other, say 75%. And that 75%, they owe me interest on top of it. So I'm not only making my money back, I'm also earning interest on my money. And if you think about it, you put that in the market, you put that in this, not in the market, but you put that in the CD, you're not getting much money for that. And let's just say I put it into the market. Who knows what's going to happen in the market? But I do know I've owned this property forever. It's a good property. If this guy defaults and stops making my payment, I'll take back my property at a discount from what I sold it to him at. So it's a win-win for both parties. So end up buying the property, sell a finance deal, and it's basically quadruple. These deals don't have to be foreclosures. They don't have to be short sales. You don't have to have that type of scenario. But there's a time that comes that someone needs to sell. And when it's an illiquid market, you are going to get what the market deems that what the true value is. And when the market is irrational, right? What I'm assuming is the market's going to go down and it's going to become irrational and the prices are going to fall. At that point, I'm going to buy. And what I'm going to be aiming for is to buy the most irrational price, the property that has dropped the most compared to what it's truly worth. Because again, it doesn't make any sense. This should be worth more. And at times you're going to go and see that and you're going to be like, this doesn't make any sense. Am I doing something wrong? Is there something wrong here that I don't see? And then what you might find out is, no, you did your homework. You are correct. This is a great deal. And this is an opportunity for you to buy and make a lot of money. So that is kind of the big thing, is to be prepared. When it becomes irrational, you can buy them in your favor. There's a times right now where the markets are irrational, where they're very high and they're almost too high. So, and a lot of properties are too high. So be conscious, be careful that you're not paying irrational prices. All right, so I got a question here. It says, besides subject to deals, how else would you capitalize when credit restrictions and layoffs? So just so you know, when you're buying an investment property, your income doesn't technically have much to do with the purchase of the property. If you're buying a property that is making money, like if I'm buying another fourplex, they look at my income, but my income doesn't have that much to do with it compared to, is that property making money? And can that property cover all of the expenses? That is what they're looking for. Can it cover all the expenses? Can it cover the loans? And do you have enough cash in reserves to cover payments? And normally the answer is 6 months. They want you to have 6-month liquid reserves for the mortgage, taxes, and insurance payment. So again, when the credit market restricts, investment properties don't technically restrict as well. And to answer another question that someone actually sent me, and I'm consistently getting this question, if you're buying a property in the scenario where market constricts and you have to put down more down payment money, or if you're doing an FHA loan and you have the 3.5% down, but you don't have the closing costs, you can always buy a property and get a seller's credit. And normally your seller's credit can be up to 6% legally before you start affecting loan guidelines. So if you're buying a $200,000 property and you have enough money for the down payment, but you don't have enough money for the closing costs, you could get up to 6% credit from the seller, which is about $12,000. So check on your state, check on the restrictions for your loans. All of that differs. But overall, you can roughly get $12,000. Normally, closing costs are roughly $6,000 to $7,000. So even if you only got $6,000, that's still a significant amount of money, and you would only have to come up with maybe $1,000 difference. And you can also get a credit from your family, meaning your family can give you some money, and that's acceptable. You can also take money out of your 401k. I don't know what's going on with my batteries, but this one's about to die too, so that's weird. All right, guys, so if it dies on YouTube, I apologize. I do not know why my batteries are doing this. It's very weird. So I apologize, but I will still be on IG for a little while longer to answer your questions. Eduardo says, thank you. One more question. Should you have a loan lined up to buy a property or wait until you find the property and then apply for a loan? Normally, you can get pre-qualified, but your pre-qualification is usually only good for like 60 or 90 days. So if it's a very long time before you buy the property, it probably won't be necessary for you to pre-qualify. Now, you should get with your mortgage broker for them to review your financial situation in ahead of time, kind of give you some tips to make sure everything is in line. Because if anything's out of line and you can't qualify for the loan, you can kind of get ready now and then, be ready for the loan. Remember, why I keep on saying, take my course, Foundations of Personal Finance. Sometimes you have issues that you don't even know you have that can take you 6 months to 18 months